Hi, welcome everybody. We're going to give everybody a couple minutes to jump on and then we'll do introductions and get started. All right, we're going to give everybody one more minute and then we're going to start because we got a lot of information to get through today. All right. Thanks everyone for joining us today. We're really excited to have you here. We were just joking that we don't think we've had this many people sign up to hear about a tax code change in a very long time. So I'm going to make this really short and sweet and introduce our speakers. And then once I do the introductions, I'll let them start. If you have a question, please put it in the Q&A. Going through the chat is really hard to find these. So if you could go to the Q&A button, which is right next to the chat button on the left of the chat button, you can put your questions there. All right, so let's get started. So today I am so happy to have Andrew Rinn and Kelly Halverson with me. They're both from Emeritus. Andrew is the Vice President of Advanced Markets, and he is a frequent speaker. I've known you have heard him here at NAFA as well as at FinSecca and Forum 400. He is also the associate editor of the Journal for Financial Service Professionals. Andrew was part of MetLife before he came to Emeritus, and he also got his degree from Midland University and his JD from Drake University. So Andrew, and then we have Kelly. Kelly is the lead of the life and annuity products team at Emeritus. Since joining Emeritus in 2012, he's been a frequent presenter and is actively monitoring all of the regulatory changes that impact our life insurance industry. Prior to joining Emeritus, Kelly also was at Mutual of Omaha, and Kelly is a fellow of the Society of Actuaries. So thank you too for your time today. I'm going to turn it over to Andrew, who's going to start us off.
Hey, Carla, thank you very much. Welcome, everyone. And thank you. Appreciate NAFA. And Kelly and I are very proud to represent on behalf of NAFA the Advanced Practice Center. So that's what this webinar that we're presenting here today is being brought to you on behalf of. So we're going to go ahead and split this up a couple different ways. I'm going to go ahead and do a little bit of an intro to kind of set the tone. We're going to do a little bit of question and answer. So these are a bunch of questions and inquiries that have come into us over the last, I don't know, probably 80, 90 days. And so we're going to facilitate that. I'm going to end most of the main presentation with some sales ideas and some opportunities. So with that said, very proud to be here with my good friend Kelly here at Emeritus. So why all the fuss about an internal revenue code provision? Think we had well over 1,000 people sign up here today to hear about an internal revenue code provision. So it's like an attorney and actuary's dream, a day like this. So there's lots of different reasons for that, but you should know this. As of January 1st of this year, 2021, the Consolidated Appropriations Act, I know that's a mouthful, kind of revolutionized 7702. 7702 has been around for a number of years, but there's been some smart changes, in my opinion, and Kelly's opinion, that brought us to the point that we're here today. And one of the reasons that we're doing this national webinar. So a little bit of speed history, if you will. 7702 is not new. In fact, it's been around for decades, going all the way back to the 1980s, as a matter of fact. So just know that 7702 is essential to how life insurance operates. It allows life insurance to maintain and retain its tax-free nature, both from a death benefit perspective, but also a cash value accumulation perspective as well. So 7702 is big. It's been big for a long period of time. Also know this: 7702 is really part of the definition, actually the core of life insurance itself. When insurance companies, whether it's our company like Emeritus or any other company, when we manufacture and create life insurance products, they have to be consistent and abide by the rules of 7702. It's that important. In fact, we don't file products or have them approved unless they're complying by this Internal Revenue Code provision. So it's that important. So again, why all the fuss with this? Well, the problem's been this over the last few years, and most of you know this. We've been in a low interest rate environment for a while now. Problem is, when 7702 came into inception, back in the 1980s, interest rates were higher. They were quite a bit higher. And so those higher interest rates were hard coded, embedded, if you will, into 7702 back then. And so you'll hear some terms today, and don't get caught up in the terminology if you don't want to, but I got to throw some at you here today. Those higher interest rates were tied into things like a guideline premium test, something called CVAT, the cash value accumulation test, MEC. Those all put us in a position where, for those three tests, we were stuck at 4%. And for a single premium under GPT, 6%. Those are huge, huge numbers compared to the 1.5% rates we've been at over the last few years. So who cares? Who cares about any of that? The problem is it created a big disconnect, if you will. Insurance carriers were not able to properly price their life insurance products in such a way as to optimize their effectiveness, to optimize their efficiency for our consumers, our clients, who we're trying our best to go ahead and do a good job with. So, I mean, some carriers were in a position where it was very hard not only to price, but even to offer many life insurance products at all because of those underlying higher interest rates, even though we're in a low interest rate environment. Maybe a good way to picture it is this, and I think this analogy, for whatever reason, seems to work with 90% of the people that we use it with. So, and I didn't come up with this. I've seen this bandied around a little bit. Just picture a big envelope, if you will, an oversized envelope, halfway full of a stack of $100 bills. All right. So big envelope, that's the death benefit. The bills are like the cash value accumulation. That's not very efficient. So the price per unit is extremely high in that sort of a scenario. So one way to visualize 7702, and you're going to get this in just a moment, is maybe two different ways. 7702, by lowering those interest rates, allowed us to shrink that envelope so it better fits the cash that's in the envelope. So that's more costly per unit than it was before. Alternatively, with the alterations to 7702 did at the beginning of this year, is allow us to put more cash in that oversized envelope. So if we leave the envelope alone, the death benefit, we could put more value, cash value, into that envelope per unit. So again, more effective, more efficient. So hopefully that analogy helps. We're going to be throwing out maybe, I think, some really pertinent examples of exactly what that means and how that holds up. Just know now that we have, at least for 2021, a lower 2% rate with a floating rate thereafter, which has made life insurance significantly more effective going forward. So what's a preview of what we're going to be hitting here today? So, I hit some of the background of 7702. We're going to see if my cohort in crime, Kelly Halverson, has any other remarks on that. But he's going to hit some of these other questions that you see here in front of you. And these are the questions, everybody that's listening here today, these are the questions that we're actually getting in the door. So I'm guessing these are some of the questions that you might have as well. As Carla mentioned, if we don't cover everything, that's what Q&A at the very end of this webinar is for. So the background, I've hit that. What's the impact of 7702 when comparing the same death benefit and same illustration scenarios? Using the guideline premium test, or the CVAT, as the life insurance qualification test. What does that mean, and what should I use, and what does that have to do with 7702? What are the advantages and disadvantages of each of those approaches, using the GPT or the CVAT approach? What if we set the death benefit, the minimum non-MEC amount, or something higher? What happens? What utilization do we have with 7702 going forward as carriers adjust their products in light of this new tweak to 7702? How does it impact larger case scenarios? I'm going to revisit you on some of those scenarios going forward before too long. This is just a sampling of some of the questions. So again, you have an advanced markets person, an actuary with you today to take that journey. So without any further ado, I'm going to be controlling the slides, and we'll go ahead and start with the first question. Kelly, I'm going to hand the baton over to you. Is there anything more you want to say on that first question with the background of 7702? If great, we'll do it. If not, I'll go ahead and go on to the second question, but it's all yours, Kelly.
Thanks, Andrew. Yeah, and thanks everybody for joining today. Definitely an exciting opportunity for Andrew and I to be able to share our thoughts on 7702 with each of you. So if you look at the Q&A, you're already going to see I took care of the first question right off the bat. I was not expecting to get that one. How many words are in 7702? And a quick Google search gave me about 3,500 words. So you can spend your evening taking a closer look at the exact language of the reg with the link I provided there. As far as the background of this revision to 7702, there's only one thing that I would add, the why behind the timing. I know Andrew talked about low interest rates being a big driver behind this, but I would say as the industry, in particular, the industry that focuses on whole life products has been looking at revising their products over the last several years. That last bullet point on there really drove the issue. It's having a contract rate of 4%. There were situations where if you wanted to offer a 5-pay, a 7-pay, a 10-pay contract, you couldn't do it in a whole life chassis without having some issue ages, risk class combinations ending up being a modified endowment contract right out of the gate at issue, which is certainly not what anybody wants to have when they're looking at an accumulation focused sale. So that was a big driver behind it. That's why NAIFA, other organizations really lobbied, Congress lobbied to get these changes in place, and a huge part of why this change ended up happening at the beginning of this year. So I think that covers the background piece of this. On the following slide, you'll see some more details on background, and just the way that it impacts carriers differs quite a bit based on what kind of products they're offering. So lucky for me at Emeritus, we have a very broad portfolio, so everything on the page impacts us to some extent. So what you'll find is every single carrier has taken a different approach to this. Some of them were unbelievably quick right out of the gate, making changes in February to reflect the revisions to the 7702 interest rates. So that typically involved the UL, index UL, variable UL contracts, where they've already transitioned those contracts to show the new rates on their illustration softwares, on their admin systems. So a lot of those changes are already in place. Whole life products is a much more involved change that needs to happen on whole life, because today, every whole life product that's offered on the market has a contract rate that's one of three numbers. It's either 4, 4.25%, or 4.5%. And all three of those contract rates cannot be offered come 1/1 of next year and still meet non-forfeiture compliance. So that last bullet point changes to our whole life products later this year. That's all. We can change that to say all. Every whole life product in the industry needs to change. So that's typically been the approach we've seen most of our competitors taking, as well as ours. Address the UL products first, and then have a bigger reprice effort associated with making the whole life changes. So if we go to the next slide, we'll see on the next question, what's this impact? What's it look like? How does this change a same death benefit or same premium illustration scenario? Because we can go into reading all 3,500 words of the new regulation, but I think the effects, what it means for an illustration, what it means for a client, are certainly more impactful, more helpful for everybody to see. So just a couple of different ways to look at that. So I'll probably start with situations where it's a protection focused sale. All this really doesn't matter. It's kind of a non-event. So if it's protection focused, you're funding well below the MEC limit, well below the level guideline premium, it's not a big deal. You'll just keep paying the same premiums that you were before the change. The guideline will be a little different. You have more MEC capacity, but in effect, it really doesn't change the whole sales experience. On the flip side of that, overfunded life insurance scenarios, you see two big ways that could change. So the first one, you have the exact same death benefit amount. The client can put in more premium. than they had in the past. So that's just, you have more room, more guideline level premium room, you have more MEC limit room. And by MEC limit, I just mean the maximum premium you can put into the contract in a year without turning it into a modified endowment contract. Second way to think about that, if you take the same exact amount of premium that you put into a contract last year, and you say, I want to do that in a new issue this year, the minimum death benefit needed to avoid MEC is considerably lower. So you can have a lower specified amount, you can have more potential for cash value accumulation because you've got less net amount of risk at play. That means you're going to pay less policy expenses, less per unit loads, less cost of insurance. So there's more dollars that are going to be staying in the contract and accumulating cash. So that's the other way to view this. So both these changes are advantageous for certain clients, those clients that really have an objective of maximizing the cash value growth in the contract. So here's an example for you to look at. This is one of the products we offer here at Emeritus. And this is just to show you, let's put everything apples to apples. Keep the same death benefit, 500,000, and we'll show you old CVAT approach, new CVAT approach. And then also on the right, you can see the guideline premium test structures. And the first thing that jumps off the page is those huge increases in premium. So on that first one, CVAT, 102% increase in premium. So it basically means you can double the amount of premium you're putting into the contract. It's not quite as high of an increase on the guideline premium test. And I should also note, this is just one example. It's not consistent across our entire portfolio, not consistent across all issue ages. This one is summarized below: a female age 40 in good health, a preferred non-tobacco risk with that 500,000 in face amount. So the comparisons aren't very helpful on here just because we're throwing completely different amounts of premium in. It really just shows if somebody wants to maximize the funding capability in a $500,000 contract, the place you build the most possible cash is going to be that CVAT at year 25, $1.9 million of account value on this assumption, 6.2% illustrated rate. It's an index UL contract. Then also that would allow you to get the most loan potential out of it as well. On the flip side, you had to pay twice as much to get that extra performance. So if we go to the next slide, you'll see a similar comparison, but we're going to look at it on a premium basis. So let's say every example, we're going to put exactly $10,000 in. And I think this really captures the way 7702 is impacting producers, the way it's impacting clients, and helps to highlight the different trade-offs of what's happening throughout the life of the policy. So right out of the gate, the biggest change is that face amount. So if you're on a CVAT policy before and you stay with CVAT, you have half the death benefit. So you put the same exact $10,000 in, and you only need $150,000 of death benefit to still fit within the MEC limits. Again, on the GPT, that's $200,000. So it's still quite a bit lower than before, but it's not quite as big of a decrease. Then on the accumulation side, over the first 10 years, the most efficient way to build cash is in that policy that has the lowest initial death benefit. So that's where post 7702 CVAT takes the lead, 124,000 in cash, just slightly ahead of the GPT. And that continues all the way through to 25 years in. But the gaps really start to narrow once you get into comparing loan out of the contract. So this is using fixed loans or variable loans for about 20 years, basically from the time you stop funding premium at 65 to attained age 85, taking level distributions either through fixed or variable loans. And what you'll typically find, and this isn't consistent on everybody's product, on everybody's issue age, risk class, face amount combination, but the general rule of thumb we're finding on if you stay on that page there, the gap between CVAT and GPT has narrowed considerably. So if you were to look at old CVAT, and we'll just focus in on fixed loans, 38,000 was the old, 44,500 was the old GPT. That's a pretty big gap in performance. That's why a lot of people would choose GPT in the past. You have less net amount of risk, you have lower corridor factors with GPT. So over the longer term, you can accumulate cash a little more efficiently on GPT. That gap is still there, it's just much smaller. So we're looking at 46,600 versus 44,500. So that's a much tighter difference, and that continues even into the variable loans. So what was a pretty clear-cut decision to say, I always put my overfunded clients into a GPT structure. There may be situations now where you say I might I might choose to put them into a CVAT just so I can overfund to a higher extent in those early years, or short pay. Maybe I only want to do a 5 or 6 pay instead of pay all the way to 65. So I think this one really does help to capture the trade-offs between the old and the new structure. On the following slide, I think we're going to continue to focus more on the new structure and the new trade-offs, and really trying to get into what is the optimal design. So we've got 4 different ways to lay these out. There's going to be a number of examples like this where we look at starting as an option B, doing a switch at age 65 to an option A, and then we look at option A in all years, and we're running that both GPT and CVAT. And very similar to the analysis we just showed you. If we keep everything at 500,000, the maximum premium you can put into the contract is going to be on the CVAT design. The only thing that's holding you back is the MEC limit. So in this case, MEC is 32,849 on a GPT. GPT level premium limit on option B is 24,753. So you can't overfund it quite as much. And then if you go over to the right, the GPT option A, you only put 8,000 into that option A. So if you're really focusing on option A for overfunding, CVAT gives you so much more capability to throw dollars into the contract, get into corridor faster, build cash faster. So that's a big consideration if you are leaning more towards using option A in some of your case designs. On the left side of the contract, there's the one that wins in each of these columns we've highlighted in green. Shouldn't come as any surprise that the option A ends up being the winner throughout a lot of these periods where you're not paying for that extra net amount at risk. On the option B, as you get into corridor, you're going to pay a little bit more net amount at risk. So this is showing you the option A does perform a little bit more efficiently. It's very, very close. See, there's only about a $200 difference between CVAT on a B to A switch, 148,000, 148,000. Same holds on the variable loans. So those end up converging a little bit more. Again, assuming you start at the exact same face amount. If we go to the next slide, I think it's going to show us the same premium comparison. Well, I guess we've got a little bit more of the trade-offs, the advantages, disadvantages. Why would you choose one design versus the other beyond just the numbers I'm showing you on the illustrations? These concepts we have on the page, these are emeritus features we have on some of our products. A lifetime income rider, an overloan protection benefit. Those are only offered on guideline premium test contracts. So that is a compelling reason why a lot of our producers do end up choosing guideline premium test when they're looking to overfund permanent life insurance, utilize it for supplemental retirement income, take distributions in later years, and then want to make sure they don't have an overloan situation where they're worried about the contract lapsing and having gain embedded in the policy and hitting an unfortunate tax event. So that tends to get people's attention and really skew more towards the GPT structure. I think I mentioned before, CVAT, one of the big things people focus in on is if you want to fund it really, really fast, CVAT's going to give you the most capacity to fund all the way up to this new, much higher MEC limit. So you'll see much higher premium limits. So you got more flexibility to overfund what may have been guideline level. It takes you 20 years to get the dollars in. You can get it in 8 or 9 years in a CVAT contract. So that tends to be what skews people in that direction as well. So if we go to the next slide, this is showing you another strategy that you could use. Let's put everybody right at the maximum premium of 32,849, which is the MEC limit. And you can see the GPT death benefits had to jump up quite a bit. On the left, the option B jumped up to 664,000. Option A jumped up to 1.9 million. So a huge increase there. But as you look further down into this table of values, again, same female age 40, preferred non-tobacco. Right out of the gate, the most efficient at year 10, that ends up being this option A, GPT. But by year 20, the CVAT design takes over. Account value ends up looking much stronger for year 10, 20, 25. That's just the most efficient way to get those dollars in. But then things change around when you look at what income you could drive. So why is that the case? If I've got more cash at age 65 on a CVAT, how come I don't have as much distribution potential? Well, it's the same reason I've been telling people for the last 10 years, it's because that corridor differential, you're paying more COIs on CVAT because the corridor is a bit wider than the corridor on guideline premium test. So I have more death benefit associated. Not much right at year 25, but it continues to widen. 2855 versus 2860. That gap becomes bigger between total death benefit and account value as you get into those older years. And that ends up costing some of that loan potential, that accumulation potential. So in those scenarios, the GPT still wins out on the B to A switch. That does get you the most potential for both fixed and variable loan income. So again, these are just some of the trade-offs we find in our existing portfolio within one of our IUL contracts. Generally speaking, these tend to hold up as I've looked at a few of our competitors' products, but these are the paces that you're going to want to run some of those accumulation-focused UL, IUL, VUL contracts through, and really get a handle on what it means for the products that you're accustomed to writing. So we move on to the next one, advantages of each approach in this scenario. GPT, again, just what I was talking about before, gets you access to a couple of those riders, gets you the highest potential cash flow. So if you're really concerned about having a stream of supplemental income, that's really compelling on the guideline premium test. CVAT, if I want to have higher account value all the way through, all the way to age 65, we're seeing much higher account values on the CVAT, and then higher death benefits in those years 20 plus as you move into that corridor amount. So could be that some people, I don't want to pay for that early death benefit, but I'm okay with having extra death benefit at age 85, 90, 100, and that corridor move upward. They may say, I like that in the CVAT. So there's a million different ways to design these, and they all can be a little bit tweaked and different just based on what the client interests and needs are. So those are just a couple of the advantages and comparisons on that specific scenario. So here's another one that's the same premium comparison. Instead of the 32,000, we brought it back down to the 10,000 level premium, and brings in another wrinkle or wrench, depending on your perspective on this, of another column or row you haven't seen on here, and that's target premium. So what you'll find on these 4 different designs is there's a pretty big gap between target premium, if you go with a death benefit option A guideline premium test, where out of that 10,000, 6,300 is fully commissionable at target. But if you do CVAT with the smallest possible face amount, either option B or option A, that's only 1,600. So 16% of your death benefit or of your planned premium is fully commissionable versus 63% fully commissionable. GPT option B to A, that's 21% fully commissionable. Again, just the example of the product that we're looking at here, that's going to vary a lot as you look at different products. But what you find is that difference in cost and difference in face amount really does change the accumulation potential. So I'll just focus in on account value for this example. It's very consistent with what we've seen on some of these prior ones. But the lowest possible face amount and an option A, where you're not paying for that extra net amount at risk of the initial specified amount each and every year, really just have 152,000 in death benefit until I get into corridor, which is pretty early. I mean, you look at this, death benefit at year 10 is already 244,000. That means we've hit corridor in the first 10 years by a pretty good amount, instead of the 152 at issue. But even on that design, I got year 10 account value, 20, 25, and even closer on the income potential, where we're down to about 2,000 difference versus GPT and 1,500 difference versus GPT on the variable loan. So again, it's the same type of trade-off and transactions as we've seen on the other examples. Account value in those first 20 or 25 years dominates on the CVAT structure, and then your B to A, very efficient structure for income, continues to be that winner. It's just, again, not as big as it had been on the former version of 7702. All right, let's take a look at the summary here. Yeah, similar on the advantages, disadvantages. So you're still looking at GPT if you want that higher target. Target looks a lot better on option A. Cash flows look best on the option B to A switch, and then accumulated account value looks best on the CVAT design. So a lot of different levers to be pulled and different conflicting interests, I guess, throughout the life of the contract. If there's one consistent theme, it's that depending on the year you're looking at and the value you're looking at, you may have a different answer as to what's going to be optimal for the case design. So I guess it basically means your advanced sales teams, your inbound calls to the support teams that run illustrations for you, they're going to be a whole lot busier than they have been in the past. All right, let's take a look at the next example. So another idea, should I set the death benefit right at that minimum non-MEC amount, or should I look at something higher? And with this design, this is saying, let's compare those most efficient designs, both on GPT, B to A, which would have been 200,000 in face amount, the CVAT B to A, which would have been 152,000 in face amount. Say, what if I ran them at 500,000 in face amount? What kind of trade-offs, what kind of performance difference am I getting? Well, I'm getting substantially better death benefit. You can see the death benefit wins in both of those examples for each of years 10, 20, 25. Not a surprise because you're starting off with a lot more death benefit, 2 to 3 times almost. But the account value is clearly a little bit further off. And by the time you get out to age 65, which is this year 25, 560,000 on GPT at the minimum non-MEC, 567 on CVAT, and I'm giving up about 10% of that. 510,000 is my account value on GPT and CVAT for the 500,000. So I'm giving up 10% of my accumulation of my account value growth in order to have right out of the gate more than double the death benefit, and at year 20 about 60-70% more death benefit. So again, some of the trade-offs, I may say still want to have really strong death benefit, but I'm unwilling to give up the accumulation potential. You may land on somewhere in between there. But you will find that with these designs, the cash flow performance is still going to be most efficient if you're designing at that absolute most efficient point, saying I'm going to put the minimum death benefit in for a given dollar of face amount or dollar of premium. And that's a pretty significant difference there, about 10% more cash value accumulation. All right, I think that covers this example. A little bit of a recap on that one. What's my advantage of running at that minimum non-MEC? I get the most efficient performance. The piece that I didn't mention, but on the advantages of starting off with a little more death benefit, is that last bullet on the page. I have some more room. I could pay additional premiums, maybe the client mid-career and they've got opportunities for advancement. So a couple of years from now, they're looking at, hey, I need to put another 20,000 a year into this contract, but we already designed it at the minimum non-MEC limit. So got to go back through underwriting. I got to do a conversion, the face increase, whatever it might be. And you lose that ability to throw additional money in should it become available. So that is an advantage of having a little bit more cushion in the design right out of the gate to plan for having some additional increases in future premium. A lot of companies' illustration software will allow you to put in an increasing planned premium so that it will also solve for what's the minimum face amount I need at issue in order to accept those 4 or 5 or 10 increases in planned premium over the next 20 years. So another thing to consider as you're looking at designing these. And it looks like we're getting a few questions in the Q&A. I think we'll probably save most of those for the end, but clearly we haven't covered every question everybody has under the sun. We're at 6 so far that I've gotten through, but for every question I get completed, looks like we're generating 2 more. So I'll keep my my comments a little bit more brief on these next few examples, so we make sure we have enough time to cover the discussion and the Q&A that people are putting into the Q&A function. So this one's a short pay scenario, and the reason we wanted to show this is max funded 5 years. It's a much different structure than what you're going to be able to do on a pay from a female 40 paying to 65. 25-year planned premium that tends to push the tide toward guideline premium being most efficient. If I got to get all the money in there in the first 5 years, the bias is you're probably going to see CVAT look a little bit better. And that is definitely the case here on the option A CVAT. That's where you're getting your most death benefit at year 20. You're getting your most cash at year 10 and year 20. But there continues to be an advantage in the GPT design. So I think that's probably a little bit surprising as you would think about these. Even a max funded design, just 5 years of premium, you're still able to drive the most efficient performance on a GPT design. The face amount ends up being just slightly more on that B to A switch. So you start out at 1.5 versus the option ACVAT at 1.3. But performance-wise, it does have a slight advantage. Now, when I say slight advantage, we're talking $2,000 to $4,000 out of 110, 115,000. So it is a much closer decision on which of these to choose from with this update and with the new 2% 7702 rates used in both the MET calculation and in the guideline calculation, and then ultimately through to the corridor calculations. So it's a lot tighter than this used to be. This used to be 10 or 15% different. Now we're only 3 or 4% different. So yeah, I think that that helps just highlight another way to look at this if you're using a short pay design. So we can move to the next slide, please. All right, is this going to impact all illustrations or just the max funded designs? Really, the only thing that you're going to see change, I alluded to this earlier, is on a death benefit focused sale, before and after. If you got $1 million face amount on one of our protection focused products, I've got $13,700 for my annual premium before, exact same annual premium after. I have the same accumulated values. 10 years in, 25 years in, everything looks exactly the same. The only spot you're going to see some differences is if you look through our illustration at where it publishes the guideline premium, publishes the MEC limit, those numbers are going to be substantially higher. So yeah, it basically means I can put more into the guideline level premium. I could put a lot more in and still fit within the 7 pay limits. So really not a huge difference. The only place I would really see a difference is instead of paying the 13,700 level all the way to age 100, on the new design, you could pay all the way up to, on this example, 87,000 on a CVAT design for just a few years, and short pay that guarantee out to age 90 in a product like this. So you could get kind of a combination of some better accumulation potential and be able to short pay your long-term guarantees in similar products. So that's really the only place I would see structurally designing these a little bit differently for protection products. Most cases, people are saying I want to pay the minimum to age 80, age 90, age 100, and that would stay exactly the same between the two designs. All right, 7th one down. Let's take a look at what we have next. I think those were the lucky 7 questions I had. I am going to pass it back over to Andrew to talk with you about some of the other opportunities and where you can leverage these changes in 7702.
Okay, thank you very much, Kelly. Appreciate that for fielding those 7 questions. And you're right, for every 7 questions, I think we have dozens more. So it should be an interesting time for the end of our hour here. I'm going to approach this from a slightly different angle. I think Kelly and I set up very well, and especially Kelly, as you kind of got into the questions, the impetus behind 7702, and most importantly, some of the substantive changes going forward. And one of the things, Kelly, that resonated with me that you and I have talked about separately, and I heard it again today, is, this is going to be very relevant in a lot of those, highly funded or overfunded sort of scenarios. So, and that does dovetail into some larger case advanced markets applications. And that's where I get excited. So about 7702. And part of what happened in the 1980s with, 7702 Part 1 was, having those higher interest rates to avoid putting, too much cash value within a life insurance contract. And, with the lower interest rates and some of the other issues regarding our MEC and CVAT limits, that's still a concern, but now we're at more of a liberty to put more cash value, in some cases double the cash value by way of premiums as we could do even a year ago. That opens up opportunities. That opens up ways for us to think about advanced market applications. So let me throw just a few of you some ideas here today before we do the general Q&A. Think about scenarios where you want to be able to put more money into the cash values of a life insurance product for something like premium finance. Premium finance has to be structured correctly. It has to be explained really well to the client and his or her advisors, but there is an application for it. There's a chance to go ahead under 7702 to essentially beef up in a permissible way those cash values like we could never do even a year ago. What does that do? That provides more collateral. That provides more surety, if you will, for the ultimate lender and also for the client that's trying to leverage a policy in a tax advantage way, trying to take advantage of that arbitrage between the current low interest rates that we're in right now and the opportunities 7702 has given us. So I think from a premium finance perspective, I mean, there's an opportunity there as well. Think about arrangements where you have small business owners. And what I mean by that is ones with a smaller census, less than 10 employees, even less than 5 employees. For a certain number of business owners, sometimes leveraging life insurance, often whole life insurance within a qualified plan arrangement could work well. And whether we call it a 412(e)(3) or a split funded DB plan, now there's more opportunity in a tax advantaged way, utilizing tax deductions through a qualified plan to, again, leverage and utilize life insurance under 7702. Think about just basic retirement income strategies. So if, premium finance or, 412(e)(3) makes your client shy away, just think of life insurance as an opportunity to go ahead and place more premium dollars, within a life insurance product. Think of it as a supplemental retirement tool. And we all talk about, maxing out qualified plans and then utilizing life insurance as an after-tax retirement planning vehicle. We can now do that probably more effectively in an overfunded scenario now more than ever before. Non-qualified deferred compensation, one of my personal favorites. Love that idea. And again, providing a platinum handcuff, if you will, between the employer and the employee above and beyond just a typical traditional qualified plan. It could be a SARA deferral plan. It could be a SERP arrangement. Anything like that works really well. These typically are corporate-owned policies, so they make good balance sheet sales for those CPAs and accountants that like to see that. Now, with 7702, this has offered you a chance to do that more than ever before. Executive bonus arrangements. Again, keep it easy if you can. Bonusing some of those key employees, some extra compensation. It's deductible as long as it's reasonable. And overfunding a life insurance policy that's going to be owned by a key employee, not owned by the business, not owned by a retirement plan trust, non-qualified in nature, different than non-qualified deferred comp. Opportunities there with the cash value like never before. And where I'm seeing a lot of leverage here over the last couple of years is split dollar. I guess I could say now, along with a lot of my cohorts that started on advanced markets at the same time, and who you are out there. Split dollar was big when we first got in the business. Then we had the split dollar regulations in the early 2000s, kind of cooled off for a while. That split dollar is cool again. It's big. It's simpler to understand, kind of with the two exclusive regimes that they have. And with this higher income tax environment that we're going to be entering into, employers aren't overly keen, nor are key employees, on getting more income that's going to be taxed, especially if at the end of the year, going into early next year, we're looking at higher individual marginal tax rates. We could be in some situations where if you can find federal state income taxes, we're looking over a 50% income tax rate. Split dollar comes in very handy for that, especially what we call loan regime or collateral assignment split dollar, where the employee, the executive, is the nominal owner of the life insurance policy. The employer is writing the premium check. They're all deemed to be loans. The measure of that interest called the AFR, applicable federal rate, is extremely low right now. Imagine being able to fund a nice, healthy life insurance policy that's not going to add to the federal income tax burden of that key executive. Again, this is prime time for all of us in the business, taking some of these otherwise, esoteric internal revenue code provisions and turning them into an opportunity to serve our clients. You got to fit the concept with the client in a responsible way. And that's what we're trying to do with our webinar here today, is explain how it works, but also some of the opportunities as well. Business transfer is also big, especially entity arrangements where you have the business as the owner, beneficiary, premium payer, in this case of a life insurance policy that could be richly funded for business transfer. So unfortunately, we're not going to have time to go into each one of these, but I did want to go ahead and at least whet your appetite as far as realizing that there's something we could actually do with this internal revenue code provision as far as opening up opportunities for some of our best clients out there. This is an exciting time to be doing what we're doing right here in the business. All right, so I see a lot of the questions are coming in here. I'm going to go ahead and pause. And Carla, I think you're going to be facilitating the Q&A here. So it's all yours.
Great, thanks everybody. Okay, so there's a couple of questions that have been asked a couple of times. Can this be done on old business, or does it have to be new business? And if it has to be new business, then is this something that you would a 1035 exchange? What are your thoughts on that?
Kelly, do you want to start with that one? Yeah.
You bet. Yeah, I did put a comment back in the Q&A. So it does require a contract issue date January 1st, 2021 and later, in order to have those new 7702 interest rates and new MEC limitations apply. A lot of discussion with the ACLI in particular as to how this really plays out with enforced contracts. The consensus I've heard from some of those industry discussions is from the time that the contract is issued, regardless of if there's material changes, increases, decreases, everything from MEC and guideline will be based on the original rules in place at issue of the base contract. So all the way back to the issue date. So anything issued before this year would fit into the former design of the 4% and 6% guideline and MEC interest rates.
So since it's only on new cases, what do you suggest they do if they have old policies in place that they think this would be very helpful for?
Yeah, I think you definitely can look at the alternatives of doing a 1035 exchange. I mean, obviously insurability and evidence of insurability always gets a little bit harder as people age. So it's a little bit of a trickier trade-off to say if I had a 45-year-old preferred plus issued 5 years ago, and now they're a 50-year-old standard, is it going to be that much more efficient? Do I get enough lift to offset starting over and do a new contract? So it's going to be very case by case as you look at those examples. I would guess that probably there will be examples that you'd find advantages if you are funding right at the minimum non-MEC limit and you want to continue to do so, or even fund to a higher level into the new contract.
Awesome. And then there's a couple of questions about how does this affect whole life? Because
I was intentionally quiet on the whole life front, so I can give you a little bit of context on why that's the case. It's like the wild west of whole life design right now. We have more flexibility in the way companies design whole life contracts than ever before. So like I said, everybody had a 4.25%, 4.5% contract rate in the policies on the market today. That can be anywhere from 2% all the way up to 3.75% in the future. So the range that means, today, those same MEC limits I was showing you on the UL-IUL, that would stay the same if you stayed at 4%. It would get a little bit better if you went to 375. But if you put a contract rate as low as 2%, that's going to get you those same MEC limits that I was showing you on the UL-IUL, increases of 100%. So there's the potential for a lot more capacity to overfund those contracts. But the other piece though too is as soon as you change that contract rate, changes the whole pattern of guaranteed cash values. So the lower the contract rate, the higher the early guaranteed cash values are. So that's a little bit non-intuitive. And then that also has a downstream implication on the dividend, because the dividend, you take the dividend rate minus your contract rate and apply that to your reserve. So your dividend interest component's drastically different than it was on the old design if companies are moving to a lower contract rate. So the reason I don't have any answers yet, we haven't filed any of our products. We've been working closely with some of our field members to get a better perspective on what they think really matters in the changes and the updates in the whole life products. But we're not aware of any companies that have rolled out a new 7702 compliant whole life product with the intent of marketing that right now or beginning in 2022.
Yeah, Carla, I might add that maybe another way to look at it, and this is also a little bit counterintuitive from a whole life perspective, is those lower guaranteed rates, which are just around the corner with whole life under 7702, would, again, within the context of a qualified plan, whether it's 412(b)(3) or split funded DB, actually increase the actual deductions going into those arrangements. Usually the lower the interest rate, the higher amount you need to fund into the contract and into the qualified plan arrangement to meet your defined benefit targets at normal retirement age, whether it be 65, 66, 67. So that's a lot of talk, but it's just another way of saying in an inverse sort of way, those lower interest rates, at least on a whole life product, could actually help some business owners get larger deductions if they otherwise qualify to have an ERISA covered qualified plan arrangement. So there's, to Kelly's point, we haven't quite gotten to that point to see what the impact would be, so we could run some illustrations, but there are reasons to be optimistic. It could actually help some business owners.
Here's another one. If low interest rate environments goes much longer, how will this affect the cash value returns?
Kelly, that's all yours too, my friend. Oh, I get the doom and gloom ones.
The actuary.
Yeah, if you doesn't take an actuary to look at the last 10 or 20 years of dividend interest rates and cap rates to answer this question, but it's like death by a thousand cuts. It's a slow bleed as you look at the industry's dividend interest rate. It's dropped from maybe 8% in the early 2000s to 5 to 6%, and every year it seems like another 10 or 20 basis points as companies see their portfolio rates decline. So I think if interest rates stay at or near these record lows, you'd expect to see further declines in dividend interest rates, further declines in companies' option budgets for their IUL products, and then corresponding declines in their cap and participation rates on those IUL products. So yeah, that is part of why when you look at the amount of activity we've seen, we know there's been a lot of activity across the industry, that people look at the portfolio yields that we have, and yeah, this is pretty attractive right now when the alternative is 20 basis points in a money market account or a CD. So there has been a lot of interest in overfunding, and why you've seen many companies put in some premium limitations on their life products because of that impact it has on their portfolios.
All right, Andrew, it looks like you're answering the question that I was going to ask. I think there's one more question.
I see a question here about, can I see numerical examples of the various split dollar, executive bonus, deferred comp, premium finance, business transfer? I thought nobody would ever ask. So Bill, how about you and I connect through our friends at NAFA after this meeting? And I have some great case designs and illustrations I'd like to share with you after the meeting here today. Thanks for the question.
And I think maybe that's something we do a white paper on later, Andrew, that we can put in the center as well.
I think we could probably go ahead and do that as well. I think we have 3 or 4 waiting, Carla. Good point.
Perfect. Well, I think that is all the time, Andrew and Kelly, unless you have any final thoughts for us today.
No, I mean, just again, I want to thank NAFA, the Advanced Practice Center for giving Kelly and I an opportunity to talk about again 7702. Hopefully, after this last hour, that you've seen it is relevant, it is impactful. There are opportunities, and at the very least, we've given you some good focused talking points to bring back to some of your best clients.
Great.
totally agree with that, Andrew. Thanks everybody for including us in this dialogue and discussion, and hopefully it came across that it's not just an opportunity to speak, but something we're passionate about. So any chance we get to talk about illustrations, product design, and IRS insurance code, we'll jump at the chance. So hopefully we'll get another avenue to do so in the future.
So thank you. These slides will be available on Monday in the archives of NAFA. You'll be getting an email after this. Thanking you for attending, and then also telling you where you can find those slides and the recording of the video. Also, if you enjoyed this and are looking for more advanced practice material, don't forget we have our Impact Week coming up October 19th, 20th, and 21st, where we'll have a whole slate of folks talking about business planning and advanced markets. So thank you so much for being with us today, and we look forward to seeing you again.